A recovery is basically getting money back for something you deducted or took a credit for in an earlier year. Think refunds, reimbursements, and rebates. Here's the catch. It's only taxable to the extent you got a tax benefit back then. On the EA exam, they'll test this idea more than the vocabulary. If your prior year deduction didn't reduce tax, the recovery usually isn't income now. This is the tax benefit rule in one sentence. Include the recovery in income only to the extent the prior year deduction or credit reduced your tax. So you're not taxed twice, and you're not allowed a double benefit either. Exam tip. When you see the phrase "to the extent," your brain should immediately go to prior year tax benefit, not the current year. The most tested recovery is the state or local income tax refund. The rule is simple. It's potentially taxable in the year received only if you itemized last year and the deduction actually helped you. If you took the standard deduction last year, your state refund is not taxable federally. That's why two taxpayers can get the same refund and have different federal results. A classic example. Steve took the standard deduction last year. This year he gets a $600 state refund tied to last year's payments. Even though it feels like income, it's not taxable federally because he got zero federal tax benefit from paying state tax last year. On the exam, if they tell you standard deduction, that's your shortcut to refund not taxable. Now, what form shows up? Usually Form 1099-G, certain government payments. States issue it for refunds and send it by January 31st with a copy to the IRS. Exam tip. A 1099-G doesn't automatically mean taxable, it's just a reporting document. Your job is still to apply the tax benefit rule and the prior year itemized versus standard fact pattern. Marcus received a state tax refund related to his prior year return. He itemized deductions on Schedule A last year and plans to itemize again this year. How does Marcus's state tax refund affect his current year federal return? Your choices include: report the refund as income, reduce this year's state tax itemized deduction, it doesn't affect federal taxes, or none of the above. Think about it. The correct answer is, report the prior year state tax refund as income in the current year. Because Marcus itemized last year, the state tax deduction likely reduced his federal tax, so the refund is a taxable recovery under the tax benefit rule. The tempting wrong choice is reducing this year's itemized deduction, but the refund is tied to last year's deduction, so it's handled as income this year. Which of the following would never be considered a taxable recovery? A rebate of a schedule, a deduction from last year, a state income tax refund, an insurance reimbursement, or a federal income tax refund? Pick the one that can't be taxable as a recovery, no matter what. Think about what was deductible in the first place. The correct answer is a federal income tax refund. Federal income taxes aren't deductible on your federal return, so a refund can't be a recovery of a prior year deduction that produced a tax benefit. A state refund can be taxable if you itemized, and reimbursements or rebates can be taxable if they relate to a prior deduction that reduced tax.